In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about the specialty chemical sector and I'll take an example of three Indian companies that operate in this space in order to understand this space a little bit better. And in the second story, I'll talk about how Indian medical implant makers are very quietly disrupting a life critical and once foreign dominated market now. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 21st of May. See, if you've been watching our videos for a while now, you probably know that we usually pick up one sector and go deep into it. But there are still quite a few spaces that we as a team have not yet touched. Not because they're not important, of course, but actually because they're hard to cover properly and we're just a small team of people figuring out things on the go, to be honest. Now, one of those spaces is chemicals, and more specifically, specialty chemicals. Now, the thing is, it's a complex industry and all of us in the team are new to it. So the thing is, instead of doing a big bang overview of sorts, we are trying to start small. We've picked three companies, which is Aarti Industries, Fine Organics, and Privi Speciality as entry points into this sector. Now, these companies, for your context, operate in very different segments, which makes it very interesting. And therefore, by looking at their latest quarterly results as well, we'll get a very good sense of how this entire industry works, what makes it challenging, and why so many Indian companies are trying to move up the value chain right here. Now, fair disclaimer, some nuances might get missed here and there, but like I said, this is just part one, and we'll be sure to cover more on this sector very soon. Anyway, let's start from the very basics. The chemical industry at its very core is about turning raw materials into compounds that other industries use in order to make finished goods. Now, these raw materials could be minerals, petroleum derivatives, natural oils, or even agricultural byproducts. Now, from these, you get everything, right from plastics and paints to fertilizer, fabrics, and even fragrances. Now, this entire industry is broadly divided into two types of players. One is bulk chemical companies, and the second is specialty chemical companies. Now, bulk chemical companies are what most people think of when they hear the word chemical in the normal sense. Now, these are standard and high volume industrial compounds like sulfuric acid or caustic soda. Now, the use cases are very wide, but they are not really differentiated. They trade like commodities and their prices swing based on global supply and demand. Margins are also low and it basically is a scale game here. But on the other hand, specialty chemicals are very, very different. They are not about volume as such, they are actually about function. Now, these specialty chemicals do something very specific. For example, a chemical that helps shampoo foam better, or an additive that makes plastic easier to peel, or even maybe a molecule that enhances a scent. Now, all of these are high performance inputs that usually make up less than 1% of the final product, but without them, the product does not work the way it ideally should. And that basically makes specialty chemicals a lot more resilient. Customers don't switch suppliers easily. They care about performance, consistency, and long-term partnerships. But again, this also means that the bar for entry is very high. You need to develop products in collaboration with customers. You also need to meet regulatory and safety standards, and you need to build trust, which is built over many years. And because all of these niches are so specialized, this industry is very highly fragmented. Unlike cement or telecom, where a few large players dominate, specialty chemicals is actually made up of hundreds of small companies, each of them focused on their own tiny space. To give you an example, one company could possibly only be doing textile chemicals, another one might actually be focusing only on aroma molecules, one more could be a surfactant experts, and all of these subsegments have their own supply chain, their own regulations, and their own business playbook. Now, in India, we have historically been a bulk chemicals country. We are big on volume, cost, efficiency, and also exports of basic intermediaries. But the thing is, over the last 10 to 15 years, that has slowly begun to change. See, as global demand for specialty chemicals has grown, some Indian companies have started climbing up the ladder by investing in R&D, working closely with international clients, and also trying to become reliable, higher margin suppliers. Now, one big reason they could do this is because China, which was once dominant in this space, began pulling back. Basically, as part of its environmental crackdown, the Chinese government shut down thousands of polluting chemical factories, which forced global buyers to look at options elsewhere. And of course, many of them found Indian companies ready to step up right there. Today, India is among the world's top exporters for certain specialty categories like dyes, pigments, surfactants, oleochemicals, and so on and so forth. But the thing is, it's still very early days. And that brings me to the companies that we are looking at today. Let me start with Aarti Industries. See, Aarti Aarti operates in a very specific niche. It makes derivatives of benzene and toluene, both of which are compounds derived from crude oil. The company does not make finished products, nor does it trade raw materials. Instead, it actually sits somewhere in the middle by converting basic chemicals into intermediaries that other companies can therefore use in order to make dyes, agrochemicals, polymers, pharmaceuticals, and even fuel additives. And what gives Aarti an edge is its level of integration over here. See, most companies in this space focus on a narrow set of products, but Aarti takes benzene and toluene and converts them into a wide variety of downstream chemicals, which creates multiple value chains across different industries. Now, this gives them flexibility, operating leverage, and also relevance across multiple sectors. But the thing is, FY 2025 was not at all easy for them. Many of the end user industries that Aarti serves, especially places like agrochemicals and polymers, went through a very bad down cycle. And on top of that, global prices for most of their products came under a lot of pressure. A lot of this was, of course, driven by excess supply from China, and while Aarti was able to move more volumes, they could not charge as much for them. Prices were weak, and input costs, particularly energy and freight, stayed very high. So even though their Q4 revenue grew by 13% year over year to around 2,200 crore rupees, their EBITDA actually fell 6% to about 260 crore rupees. And their net profit also dipped 27% to around 95 crore rupees. Now that, mind you, is a very sharp decline. One part of their business, which is what they call non-energy, which includes core specialty chemicals, saw volumes rise 14% quarter on quarter. Their energy segment, which includes steam and utilities, also saw a 21% volume increase. Now that, of course, is a good sign because demand is coming back, but still the margins are very thin. Why? Because the pricing environment is still very poor. Agrochemical intermediaries in particular have been very badly hit. There is too much global supply and not enough pricing power. As Aarti's management puts it, yes, volumes are improving, but incremental sales are happening at marginal pricing because China's overcapacity keeps pushing our prices down. But still, not everything here is gloomy. One very big bright spot is their MMA business, which is monomethyl aniline, which is used in fuel-related applications. Volumes here went up almost 40% year on year, and they have started exporting to newer geographies like the US and Europe. It is still early stage, of course, but it shows their ability to build future-facing product lines. The company, by the way, is also cutting costs very aggressively. In FY 2025, they completed several efficiency projects, which is things like switching to hybrid power, installing better turbines for steam, improving raw material yields, and so on and so forth. Now, these, of course, will not move the needle significantly overnight, but they will protect margins over time for sure. Capex is also a big theme for Aarti. They spent over 1,370 crore rupees in FY 2025, and they plan to invest another 1,000 crore rupees in FY 2026. And the bulk of this is going into something they call Zone 4, which is a new facility with multi-purpose plants that will allow them to make more advanced and higher margins chemicals, especially for pharma and agri customers. But the impact of this unit will only start showing up after FY 2025. Until then, though, the focus is more on sweating the existing assets. Currently, utilization levels across many categories are very low. For example, the PDA chain, which is used in polymer applications, is just at 33% utilization. Even MMA, despite its strong growth, is at 62%. And that means there is headroom. If demand recovers further, Aarti can grow volumes without needing more capacity. Anyway, now let's move on and talk about the next company, which is Fine Organics. Now, Fine does not play in the bulk chemicals or intermediary space. It actually makes specialty additives, which is tiny functional ingredients that go into food, plastics, cosmetics, coatings, and even animal feed. Now, these are not headline ingredients as such. They are actually small volume, high impact compounds. A cake mix might contain less than 1% of a fine additive, but that 1% makes the cake fluffy, stable, and also consistent, and therefore it is very important. What is interesting is that Fine works in a segment called oleochemistry, which means that its additives are made from natural oils and fats, not really petroleum. So things like palm oil, castor oil, sunflower oil, these are all the raw materials, and this gives them a sustainability edge as well. As global consumer brands are looking for bio-based alternatives to petrochemicals, Fine's relevance increases all of a sudden. But the thing is, this is not just a plug-and-play business. Every customer engagement is long-term over here. Getting a single product approved can take as much as 6 to 12 months, which is why Fine does not chase too many clients at once. They only focus on a few clients and they try to grow wallet share over time. In FY 2025, Fine saw decent revenue growth. Q4 revenues were up 11% year over year to 607 crore rupees, but the profits actually went the other way. EBITDA fell 17% to 120 crore rupees and profit after tax fell 15% to 97 crore rupees. You might ask me what happened? See, input costs spiked for them. Palm, castor, and sunflower oil, which are their key raw materials, as you may have figured by now, became more expensive in the second half of the year. And because many of these clients operate on long-term contracts, Fine could not immediately pass these costs to them. They could, of course, raise prices for smaller customers or spot orders, but the larger ones were locked into their system. So therefore, margins were compressed. That said, there is one more constraint over here, which is capacity. See, most of Fine's plants are already running at near full capacity. The only major headroom is their E73 plant in Patalganga. They're also working on two major projects. First is a new facility at JNPA or Navi Mumbai, which is located in a special economic zone. This will be focused on exports, and once it is up and running, it will free up existing capacity for domestic growth. Second, a manufacturing facility in the US. See, Fine already serves US clients via exports, but shipping honestly takes 2 to 3 months. A local plant will improve delivery timelines, strengthen relationships, and will also allow for deeper penetration in the market. Now, that is a huge shift, and it is Fine's first time in setting up a manufacturing base outside our country. So they will start with familiar products and they will gradually then expand. But they're also well capitalized and are sitting on over 1,100 crore rupees on cash with zero net debt, and they are also open to raising debt on doing acquisitions if required. That said, let's now move on once again and turn our eyes to Privi Speciality. Now, Privi makes aroma molecules, which are the raw materials that go into your fragrances. Not perfumes themselves, but the base chemicals that give a product the smell. You can think about personal care, home care, hygiene products, and basically anything that smells good. All of it probably has an aroma chemical behind it. And Privi is one of the largest players in India in this very space. They make over 70 such molecules, and each of it has its own scent profile. Now, these are then sold to some of the world's top fragrance and FMCG brands. So this is not just a volume business, it is also about quality, consistency, and relationship depth with the companies. Now, what gives Privi as a company an edge is its control over inputs. See, most aroma chemicals globally are derived from pine-based raw materials like CST, which is crude sulfate turpentine, and GTO, which is gum turpentine oil. These are difficult to source at scale, but Privi has invested years into building secure access and integrating backwards. They have also built smart systems to use byproducts from one process to make entirely new high-margin molecules, like using kitchen scraps to make sauces, for example. And Q4 was their best quarter ever. Revenue jumped 28% year over year to 628 crore rupees. EBITDA rose 50% to 147 crore rupees, and their net profit more than doubled to 64 crore rupees. Margins were also excellent. Their EBITDA margin was at 23.5% and PAT margin was over 10%. Now, what's important is that these were not fluke numbers. These gains came from process improvements, yield enhancements, and a better product mix. As their CFO Narayan Iyer said, this was not just a one-off windfall, it was structural. Some other income helped, but the real driver was internal efficiency. Anyway, Privi is now also scaling some new molecules which are being very well received by the market. Their current installed capacity is 48,000 tons with utilization already at an 85 to 90%. But instead of setting up new factories, they are upgrading processes to squeeze out more. They expect to hit 54,000 tons by March 2026 with a capex of 250 to 300 crore rupees. Their focus is on high value, low volume products, which is things that sell for over $100 a kg and often use byproducts as input. And that basically gives them a double margin boost in some sense. Another interesting thing that they've done is reducing customer concentration risk. A few years ago, they had just 3 major clients, but now they supply to 6 out of the top 10 global fragrance players. And that's not even the end of it, there is a lot more here. Earlier this year, they launched a joint venture called PRIGIV with a fragrance giant called Zerodha. The idea was to co-develop and manufacture aroma ingredients that Zerodha would then buy back. Right now, the scale of course is small at about 4 crore rupees in FY 2025, but the company expects this to grow to 300 to 350 crore rupees in just the next few years with a break even by FY 2027. Now, this is a strategic anchor and is a long-term predictable revenue stream with a very clear margin visibility. So now if we zoom out across Aarti, Fine and Privi, what you see is 3 different models. One is building scale and depth across value chains, another one is focused on niche relationships and green chemistry, and the third one is using innovation and integration to command pricing power in a sensory-driven category. But together, they give us a great snapshot of how India's specialty chemical sector is evolving. It's slowly moving from cost arbitrage to capability, from volume to value, and from export dependence to global relevance. On that note, let's move on and talk about the second story. See, we recently came across an interesting report by CareEdge on a market that most people do not even think about unless they or somebody else close to them ends up needing help. See, this is a market that is very quietly growing in the background, far from the headlines in usual cases. And while it may feel a little weird to talk about it, since there is always a health issue on the other side of a scale, it's a market that deserves attention for sure. Because behind this quiet growth, something very big is actually happening. This industry, which covers things like knee replacements and heart stents, has been quietly growing at a very high pace. Over the last 6 years, it has clocked a compound annual growth rate of around 25%, which is massive by any standard. And it is also expected to keep growing, by the way. From a size of around $2.5 billion today, it could double and touch around $4.5 to $5 billion by as early as FY 2028. So to put it simply for you, more and more people are now getting medical implants, and Indian companies are finally becoming a serious part of that entire story. So with that context in place, let me explain what this market is even all about. See, while talking about medical implants, what I'm usually referring to is things that go inside our body to help fix or support something that is not working properly. The Carriage report focuses on two broad categories here, which is orthopedic implants and cardiac implants. Now, orthopedic implants are used when there are problems with the bones or joints. You can think of situations like a hip or knee replacement, or when someone has a severe fracture and they need a metal rod or screws to help the bone heal. And on the other hand, cardiac implants, like the name suggests, deal with the heart. Now, these include stents to open up blocked arteries, artificial heart valves, and devices that are used in certain types of valve replacement surgeries. Now, these are not just any products, mind you. They are life-critical devices. If a heart implant does not, God forbid, work properly, the patient could die. If the bone implant, for example, fails, somebody might be left with long-term damage. So the thing is, the stakes here are extremely high, and that is why companies that make these devices have to meet extremely high standards. Their products have to be safe, they have to be durable, and have to be proven to work inside the human body for years. And that makes this business extremely difficult and also very sensitive to enter. You need world-class manufacturing, and usually in sterile clean rooms as well. You also need regulatory approvals, both from India and international agencies, and you need to run clinical trials to show that your product actually works. And once you've done all of that, you still need to build relationships with hospitals, doctors, and surgeons who will trust you enough to use your products on real patients in real life. Now, the thing is, for a very long time, this trust was reserved for foreign companies. International medical device makers had dominated this space for decades, and even now, most of the implants that are sold in India are still imported from outside the country. But that is very slowly starting to change now. Indian companies are finally making inroads here, both at home and abroad. To give you an example, in FY 2024, Indian manufacturers are estimated to have sold between $2.3 to $2.5 billion worth of implants. Now, that is almost the entire market size, and the growth is not slowing down. To get a sense of just how fast things are moving here, Indian companies have grown at an annual rate of 28% over the past 4 years. That is more than double the growth rate of foreign companies who manage just about 12% in the same period of time. And the success is not limited to India, mind you. Exports are rising even faster at around 37% a year. Now, a lot of this actually comes down to one simple factor, which is cost. See, Indian firms make implants that are much more affordable than those that are made abroad, and that makes them the preferred choice for government-backed health insurance schemes and also for price-sensitive patients in India and others developing nations. And as more and more patients opt for Indian-made implants, volumes have also naturally followed it. But the thing is, price alone cannot take you all the way, especially in a market where lives are at stake. So therefore, Indian manufacturers have also made a huge improvement in their quality. Their products are beginning to match global standards, and that is why they are no longer seen as low-cost backups, but they are now becoming credible contenders. Now, the Indian government, of course, is helping here as well. There is a production-linked incentive scheme which is focused on medical devices and has a total budget of 3,420 crore rupees. 6 Indian firms have been chosen under this scheme, and for the next 5 years, these very companies will receive a 5% incentive on any additional sales that they manage to generate, which gives them a strong push to expand their domain. And on the demand side, there are a few things that are driving this boom as well. First, India is aging in general. Now, this is not a topic that we usually talk about very often, but the number of people that are above the age of India are rising very quickly. Between now and 2050, this age group is expected to grow at more than 2.3% every single year. And that, mind you, is more than 3 times our overall population's growth rate. And since older people are far more more likely to need implants, whether it's a knee replacement or maybe a heart stent. The demand is only going to rise intuitively. The second reason is that people today are more willing and able to get medical help when they need it. Health insurance is reaching more people, hospitals and surgical infrastructures are improving, and rising incomes are allowing families to spend more on serious medical procedures. And that basically means that if somebody needs an implant, they are more likely to go ahead and actually get it. And this, of course, adds to the demand significantly. But the thing is, while things are improving in India, Indian firms still face a very uphill climb when it comes to global markets. Yes, of course, like I said, they are exporting more, but their overall share in global implant sales is extremely small right now. That is because global buyers, especially in developed markets like the US, want long-term clinical data and also a very good proven track record. The United States in particular is a big market here. It's the world's largest market for implants, but again, it's also the hardest to enter for any company, because in order to sell there, companies need to conduct large and US compliant clinical trials. And these clients are expensive and also time consuming. And even after all of that, you still need strong connections with hospital procurement teams, supply chains, and post-sales service teams. And of course, you're also going head on head with global giants who have been into this system for many decades now. But that said, if Indian companies somehow do manage to break into the US market, it could be a massive turning point. But again, it will not at all be easy. In fact, if protectionist policies like Trump-era tariffs return, it might get even tougher for these companies. Meanwhile, on the supply side, policy decisions within India have played a very important role in reshaping this industry. To give you some context, back in 2017, India's drug pricing regulator, which is the NPPA, imposed price caps on key implant products. Bare metal stents were capped at 10,500 rupees, knee implants were priced between 32,000 and 83,000 depending on their material, and these caps were also controversial in nature. Foreign firms pulled out some of their high-end products from India. There was even a short-term shortage of stents in our country. But that said, over time, the market slowly adjusted. Now, of course, medically, this is not the best situation to be in, but purely from an economics perspective, this price control created room for Indian companies to step in. So by offering quality products at lower prices, they were then able to win over customers who could no longer access imported options. And this very cost advantage continues to help them grow even today. But all that said and done, it is not very smooth sailing either. As more and more Indian players are now entering the field, including big names like Zydus, Alchem, etc., the competition is rising quite fast. And with government mandated price caps, there is not really much room in order to expand these margins. In the long run, this could slow down investment in innovation and also R&D. And in the future, if implants become commoditized and price becomes the only selling point, it could really hurt the sector's ability to push boundaries and to improve quality even further. But that said, this is still a market with a lot going for it. Demand is strong and is rising. The export opportunity is great, even if it is early. And most importantly, Indian players are very slowly starting to gain trust in an industry where trust is the hardest thing to gain. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, India's market regulator SEBI has issued a recovery notice of 2.1 crore rupees to Mehul Choksi for violating insider trading norms related to Gitanjali Gems Limited. The notice, which is dated 15th May 2025, includes a penalty of 1.5 crore rupees and accrued interest of 60 lakh rupees. SEBI warned that if the amount is not paid within 15 days, it may initiate proceedings to seize Choksi's assets, freeze his bank accounts, or proceed with an arrest. Second, Varun Beverages Limited, which is PepsiCo's key bottling partner, has announced the acquisition of a 50% stake in Everest Industrial Lanka Private Limited for $3.75 million, which is approximately 32 crore rupees. Everest Industrial Lanka is engaged with the production, distribution, and sale of commercial Visi coolers and accessories. The investment was approved by VBL's Investment and Borrowing Committee, and the deal has also secured clearance from Sri Lanka's Board of Investment. Third and the final one for the day, Heritage Foods Limited has announced a capital expenditure of 400 crore rupees over the next 18 to 24 months, including 200 crore rupees for a new ice cream facility and 100 to 150 crore rupees for value-added products and automation. In Q4 of FY 2025, the company reported a revenue of 1,048 crore rupees, which is up from 950 crore rupees in the same quarter last year, while its net profit stood at 38 crore rupees compared to 40.49 crore rupees in Q4 of FY 2024. That's all the news and stories I have for you today. I hope you enjoyed this show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.